The world of cryptocurrency has just experienced a seismic tremor, one that could reshape not just the digital asset landscape, but the entire foundation of global finance as we know it. For the first time in recent memory, Ethereum, often dubbed the world computer, has surpassed the legendary Bitcoin in 24-hour derivatives trading volume. This is not just another fleeting headline or a quirky data point for traders to dissect over coffee. No. This could be the opening salvo in a new era of crypto power dynamics, a signal that the gravitational center of digital assets may finally be shifting away from Bitcoin's iron grip. But what does this mean for investors, developers, institutions, and even the everyday observer? Are we truly on the cusp of a new financial epoch? Or is this simply a blip, a speculative frenzy destined to fade? To answer those questions, let's zoom out and examine how we got here, why it matters, and what the future might hold for Ethereum, Bitcoin, and the digital economy at large. Let's start by rewinding the clock. Ever since its mysterious creator Satoshi Nakamoto launched Bitcoin in early 2009, the cryptocurrency space has revolved around its first mover. Bitcoin established the blueprint, a decentralized, censorship-resistant currency with a fixed supply, immune to the whims of central banks and governments. For more than a decade, it remained the undisputed king of crypto, captivating investors with its epic price surges. Think of the explosive rallies in 2013, 2017, and the post-pandemic boom of 2021, and its legendary, heart-stopping volatility. In the eyes of many, Bitcoin was not just digital money. It was a financial revolution. But then came Ethereum. Conceived by Vitalik Buterin and launched in the summer of 2015, Ethereum was never content to simply mimic Bitcoin's model. Instead, it set out to do something radically different. Rather than being just a currency, Ethereum offered a programmable platform, a decentralized computer for the world. With its pioneering support for smart contracts, Ethereum enabled developers to create decentralized applications, or DApps, that could replicate everything from lending and borrowing to gaming, insurance, and voting, without middlemen or centralized gatekeepers. This simple yet profound innovation quietly sowed the seeds for the digital transformation we're seeing today. Ethereum's flexibility and programmability opened the floodgates for innovation. It was not long before developers realized they could build entire financial ecosystems directly on-chain. This gave birth to decentralized finance, or DeFi, and set off a cascade of new protocols and business models that would have been unthinkable within traditional finance. Ethereum's introduction of non-fungible tokens, or NFTs, further expanded the scope of what blockchain could do, enabling digital ownership of art, collectibles, and even virtual land. Now, fast forward to the present. The Ethereum ecosystem has grown into a behemoth, a sprawling digital metropolis bustling with activity. As of the latest data, the total value locked in Ethereum's decentralized finance, or DeFi, protocols exceeds $45 billion United States dollars. That's more than the gross domestic product of some small countries, all secured by decentralized code and cryptographic consensus. Meanwhile, the world of institutional finance is waking up to Ethereum's potential. Over 4.3 million Ether tokens are now secured within recently launched exchange-traded funds, an offering that has attracted a surging wave of institutional capital, from pension funds to hedge funds and family offices. The largest players on Wall Street, including BlackRock with their Ether fund and Fidelity with EZETH, have become early leaders in Ether ETF asset accumulation. These vehicles alone now collectively manage billions of dollars worth of Ether, a testament to the swelling appetite for exposure to Ethereum's upside. But the story does not end there. According to prominent blockchain strategist Raoul Pal, Ethereum is capturing real economic activity, such as stablecoin volume and tokenization. This is more than a soundbite. It's a reflection of the paradigm shift at hand. Ethereum's network processes vast amounts of stablecoin transactions daily, making it the backbone of the crypto dollar economy. Moreover, the tokenization of real-world assets, everything from real estate to fine art and even United States Treasury bills, is accelerating on Ethereum's rails. The growing supply of tokenized Bitcoin on Ethereum, now exceeding 270,000 wrapped Bitcoin, further underscores the network's magnetic pull on value. To appreciate the magnitude of this, consider the concept of tokenization. Traditionally, assets like property, stocks, or commodities are tied to paper certificates or centralized databases. On Ethereum, these can be represented as digital tokens, tradable 24/7, with near-instant settlement and global accessibility. Imagine being able to buy a fraction of a Picasso painting or invest in a basket of global real estate, all through a decentralized platform that operates around the clock. This is not just theoretical. Projects leveraging Ethereum for tokenization are already live, drawing interest from major banks and asset managers looking to modernize the world's financial plumbing. Technological progress is amplifying Ethereum's momentum. In March of 2025, the much-anticipated Dencun upgrade went live on the Ethereum mainnet. Its impact was immediate and profound. By radically optimizing data storage and throughput, Dencun slashed Layer 2 transaction fees by a jaw-dropping 80%. For users of popular Layer 2 scaling solutions like Arbitrum, Optimism, and Base, the cost to interact with smart contracts and move assets plunged, fueling a fresh wave of user adoption and DeFi experimentation. As Lark Davis, a widely followed crypto analyst, puts it, the Dencun upgrade is a game-changer, making Layer 2 transactions much cheaper and faster. Layer 2 solutions themselves deserve a spotlight. These are protocols built on top of Ethereum that process transactions off-chain and then record the results back to the main chain. This design massively increases throughput, reduces congestion, and paves the way for mainstream applications ranging from payments to gaming. The combination of Layer 2 technology and protocol upgrades like Dencun has made Ethereum more usable than ever before. For example, a typical transaction that might have cost several dollars a year ago can now be executed for mere cents, making microtransactions and high-frequency trading viable for the first time at scale. But Ethereum's roadmap is far from complete. The next major milestone, the Pectra upgrade, is slated for late 2025. This ambitious update promises to further boost scalability, improve user experience through account abstraction, which will make onboarding millions of new users as easy as signing up for a social media account, and lay the groundwork for even more advanced applications. As Linda Shi of Scalar Capital observes, account abstraction will be a key driver of Ethereum adoption, easing dApp use for non-crypto natives. Account abstraction is a concept that could redefine how we interact with blockchains. Instead of relying on complex wallet setups and cryptographic keys, users could have smart contract-based accounts with customizable security settings, social recovery, and seamless integration with everyday apps. This could finally bridge the gap between technical enthusiasts and mainstream users, unlocking a new wave of global adoption. Imagine a world where sending Ether or interacting with a dApp is as simple as scanning a QR code or tapping a button on your phone. The pace of innovation is mirrored by surging on-chain activity. The Ethereum Name Service, or ENS, a decentralized alternative to traditional domain names, has seen registrations explode by 35% in the last quarter alone. With over 3.1 million ENS domains now registered, more individuals and organizations are anchoring their digital identities to Ethereum than ever before. Meanwhile, Consensys, the pioneering Ethereum software company behind MetaMask and Infura, recently raised $720 million at a whopping $7 billion valuation, underscoring the surging institutional and venture capital interest in Ethereum's expanding ecosystem. This is not just a flurry of speculative interest. The Ethereum Name Service is powering a new era of digital identity, where users and projects can have human-readable addresses, like alice.eth, instead of long, unreadable strings of characters. This small shift has big implications for user experience, security, and interoperability across the web. All of this brings us to the headline event. Ethereum's 24-hour derivatives trading volume recently hit an eye-popping $59.21 billion, overtaking Bitcoin's $56.33 billion for the first time in years. This is not just a statistical oddity. In derivatives markets, where traders use leverage to bet on future price movements, volume is a key indicator of attention, liquidity, and conviction. Open interest in Ethereum derivatives surged by more than 7% in a single day, a sign that new money and new bets are flooding into the market. The long-to-short ratio on leading exchanges like Binance now stands at roughly 1.3 to 1 in favor of longs, suggesting that market participants are positioning themselves for further upside. Even seasoned analysts are taking notice. Katie Stockton of Fairlead Strategies, a respected voice in technical analysis, says, "ETH is exhibiting positive momentum. A breakout above 2,800 would target 3,500. In other words, if Ethereum can decisively clear this psychological resistance, the next stop could be a fresh leg higher, potentially shifting the balance of power for good. Yet, beneath the surface, there are reasons for caution. Despite all the progress, Ethereum's price has repeatedly failed to break through the $2,800 barrier. Previous breakout attempts have fizzled out, sometimes violently, as profit-taking and risk aversion set in. The Altcoin Season Index, a metric that tracks the relative performance of alternative cryptocurrencies versus Bitcoin, currently sits at a historic low of 27. This suggests that, for now, we are still very much in Bitcoin season, where the original cryptocurrency continues to command the lion's share of attention and inflows. Crypto history is littered with sudden reversals and false dawns, and the risk of another failed breakout looms large. So is Ethereum's surge in derivatives volume just a speculative fever? Or are we witnessing the early stages of a structural trend reversal? To answer this, we must consider both the opportunities and the risks that lie ahead. On the opportunity side, the institutional embrace of Ethereum is impossible to ignore. When BlackRock and Fidelity, two of the world's largest asset managers, pour billions of dollars into Ether ETFs, it sends a powerful signal to the rest of the market. This is no longer the Wild West of crypto. It is rapidly becoming an arena for sophisticated, long-term capital, and the stakes have never been higher. With over 4.3 million Ether now locked in ETFs and a total DeFi value north of $45 billion, Ethereum is cementing its role as the backbone of decentralized finance and the future of tokenized assets. But with greater scale comes greater scrutiny and competition. The explosion of derivatives activity raises concerns about increased volatility, as Michael Green, a leading macro strategist, points out. The rise of Ethereum derivatives reflects growing sophistication, but it also increases volatility risk. In other words, as more traders pile in with leverage, the swings can become sharper and more unpredictable, a double-edged sword for investors and builders alike. At the same time, Ethereum faces fierce competition from other blockchains eager to capitalize on any missteps. Networks like Solana, Cardano, and Avalanche are all vying for a slice of the DeFi and tokenization pie. If Ethereum stumbles on scalability, network fees, or regulatory compliance, these rivals could quickly seize market share. Solana, for instance, is attracting developers with its ultra-fast throughput and low fees, while Cardano touts its academic rigor and focus on formal verification. The blockchain wars are far from over. To understand the competitive landscape, consider how Solana, with its ability to process tens of thousands of transactions per second, has positioned itself as a favorite for high-frequency trading and decentralized exchanges. Avalanche, with its unique consensus mechanism, offers near-instant finality and low costs. Cardano, meanwhile, is betting on peer-reviewed research and slow, methodical development to ensure security and scalability. Each of these networks is carving out its niche, and any stumble by Ethereum could be quickly exploited by these ambitious challengers. Let's also not forget about the crucial role of technological security and network health. Ethereum's hash rate, a measure of the total computational power securing the network, stands strong at over 617 terahashes per second, reflecting robust miner participation and security. Yet, as the network grows and transitions toward proof-of-stake and advanced sharding techniques, maintaining this security will require relentless innovation and vigilance. Security is not just about preventing hacks, though those risks remain ever present. It is also about resisting censorship, ensuring uptime during periods of network congestion, and creating robust incentives for honest participation. The transition to proof-of-stake, completed with the merge in September 2022, was a historic milestone, reducing Ethereum's energy usage by over 99% while opening the door to new scalability solutions. However, proof-of-stake introduces new game-theoretic challenges, such as the risk of validator centralization and the need for slashing mechanisms to deter bad actors. So what happens next? If Ethereum can ride its current momentum, we could witness it solidify its dominance, not just in DeFi, but in the broader world of real-world asset tokenization and digital identity. As more traditional assets migrate to blockchain rails, think of tokenized stocks, bonds, carbon credits, and property titles, the value flowing through Ethereum could multiply many times over. This, in turn, could set off a virtuous cycle. More institutional money, more developers, more use cases, and, potentially, a new bull run spearheaded by Ethereum rather than Bitcoin. Several future scenarios are now in play. In the best-case scenario, Ethereum continues to innovate, delivering on its ambitious roadmap with upgrades like Pectra and advanced Layer 2 solutions, while regulatory clarity encourages even more institutional adoption. In this world, Ethereum could become the de facto settlement layer for global finance, hosting trillions of dollars in assets and powering a new generation of decentralized applications. Alternatively, if technical upgrades falter, or if regulatory headwinds emerge, such as stricter compliance requirements or crackdowns on DeFi protocols, Ethereum's growth could stall. In this case, rivals like Solana or Cardano may gain traction, siphoning off developers, users, and capital. History is full of once mighty networks that lost their edge due to complacency or unforeseen challenges. There is even the possibility of a technological leap, perhaps a breakthrough in scalability or user experience, that cements Ethereum's dominance for years to come. Imagine a world where onboarding to Ethereum is as simple as downloading an app, where transaction fees are negligible, and where billions of people interact with decentralized applications as effortlessly as they use email today. That future is not as far off as it may seem, thanks to innovations in account abstraction, Layer 2 rollups, and next-generation consensus mechanisms. To put this into perspective, consider the Internet's own evolution. In the early days, only computer experts could navigate the web. Over time, advances like graphical browsers, search engines, and mobile apps brought billions of people online. Ethereum, with its focus on usability and scalability, could undergo a similar transformation in the coming years, moving from a tool for the technically savvy to a global platform accessible to anyone with a smartphone. But what does all this mean for you, the investor, the developer, the crypto-curious, or the casual observer trying to make sense of this fast-moving landscape? The key lesson is this: momentum in crypto markets can shift with breathtaking speed. Ethereum's rising derivatives volume, surging institutional inflows, and relentless pace of technological upgrades are massive signals, but they are not guarantees of future success. If you're positioning yourself for the next cycle, it pays to watch the right metrics. Keep a close eye on open interest in derivatives, which can signal shifts in market sentiment. Track institutional inflows into Ether ETFs and on-chain DeFi protocols. Monitor the progress of upcoming upgrades like Pectra, which could unlock new waves of adoption. And above all, pay attention to the real-world use cases like decentralized finance, tokenization of assets, and the explosive growth of digital identity through the Ethereum name service that are driving tangible value on the network. Diversification remains a timeless strategy. Don't put all your eggs in one basket, no matter how compelling Ethereum's ascent may appear. Consider allocating across multiple blockchains, sectors, and applications. Stay nimble, keep a close eye on volatility, and be prepared for sudden reversals. Because, as any seasoned crypto veteran will tell you, no single event ever writes the entire story. To further illustrate the importance of diversification, look back at past cycles. In the initial bull run of 2013, Bitcoin was king, but then faded as altcoins like Litecoin and Ripple gained traction. In 2017, Ethereum itself ignited the ICO boom, but many projects ended in disappointment. More recently, the DeFi summer of 2020 saw explosive growth, followed by sharp corrections. The lesson? No asset, no matter how dominant, is immune to changing tides in technology, regulation, or sentiment. As we approach the end of this deep dive, let's return to the burning question. Is this a passing spike, or the dawn of a new era for Ethereum? The evidence, while not yet conclusive, is compelling. Historic upgrades like Dencun, Layer 2 fee reductions of 80%, and surging adoption by both users and institutions are reshaping the playing field. The fact that the Ethereum name service saw a 35% jump in registrations last quarter, and that Consensus just raised $720 million at a $7 billion valuation, shows that Ethereum's foundations are growing stronger, both technologically and financially. But here's the secret most people miss. Ethereum's battle is not just with Bitcoin anymore. Its real contest is with the future of the entire financial system, how value, identity, and trust will be managed in the digital age. Whether Ethereum remains in the driver's seat will depend on how it tackles a daunting set of challenges, from scalability and regulatory compliance to user experience and competition from nimble upstarts. Before we close, let's briefly consider the broader context of global finance. The world's financial infrastructure is creaking under its own weight, with trillions of dollars locked in slow, expensive, and opaque systems. Cross-border payments can take days, settlement of securities can lag, and millions remain unbanked. Ethereum, with its vision of programmable, open, and borderless finance, offers a fundamentally new paradigm, one that could finally bring financial services to all corners of the globe. Moreover, governments and regulators are taking note. Central bank digital currencies, or CBDCs, are being piloted around the world, and many are exploring how to leverage public blockchains like Ethereum for interoperability and transparency. The convergence of public and private blockchains, tokenized assets, and digital identity could usher in a new era of global finance, one where trust is encoded in mathematics, not intermediaries. In the end, the crypto landscape is evolving faster than ever. And Ethereum is right at the tipping point. The next chapter will be written not just by developers or traders, but by everyone who chooses to build, invest, or participate in this new digital economy. If you found this breakdown valuable, smash that like button, subscribe for more unbiased crypto insights, and let us know in the comments. Do you think Ethereum can maintain its new lead, or will Bitcoin reclaim the throne? Or could an entirely new contender emerge from the shadows to shake up the hierarchy?